I made an offer on a home, it's been accepted, and now there's going to be closing costs. Right. How much are closing costs? What does that look like?
So there's two types of closing costs in mortgage lending, non-recurring and recurring, okay? Non-recurring closing costs, we call them that because they are specific to our transaction. So think of that discount fee that we talked about, discount fee, appraisal, credit report, escrow and title company. There's a flood cert, there's a couple of little fees in there, and then there's some recording fees with the county. And generally, you could say those fees are probably in the range of $5,400 to $5,800, kind of in that. And I say that the range is because the escrow and title fee can change a little bit. And if the discount fee obviously would impact that. But if there's no discount fee, you're that $5,400 to $5,800. You know, if your discount fee was $2,000, now you're $7,400, $7,800. So you can count on that pretty consistently, right around that number. And then on the recurring fees, that's interest, insurance, and taxes. And we say they're recurring because those are the components of your monthly payment, okay? Mm-hmm. But these are items that you're prepaying. So you're prepaying a certain amount of interest, you're prepaying some of your insurance, and you're prepaying your property taxes, okay? So why are we prepaying these items, okay? Anytime you're putting down less than 20%, you have to have what's called an impound account, okay? Or some people refer to it as an escrow account. And what that means is that with every monthly payment, we're going to pull out 1/12 of the homeowner's insurance, 1/12 of the property taxes. We put it into this impound account, and that account just grows and grows and grows. And then from that account, the insurance gets paid every year on the anniversary of the closing, okay? And property taxes are paid twice a year, April and October, okay? So to get that impound account set up, we're going to pay the insurance premium upfront for the year at closing. And then we collect an extra 2 months of insurance to get that impound account set up. And then with the property taxes, we're typically going to collect 6 months at closing. And I say typically because I think there's 1 month out of the year where it's 7 months and 2 months out of the year where it's 5 months. But 6 months is generally speaking what we're looking at. So when you look at those prepaids, as we say, or those recurring closing costs, that's harder to estimate because the property taxes, let's say we've got a $500,000 purchase. So taxes are going to be roughly $5,000, meaning we're going to collect about $2,500. So let's say then your insurance would be, let's make our lives easy, let's say it's $1,000 annual premium, okay? So we're going to collect roughly $1,200 for insurance at closing. And then let's say prepaid interest is going to be $500. So we've got $500, $1,200, and $2,500. So roughly $4,200 in total prepaids to go along with our $5,500. Okay, so that's your total closing cost right there. And again, as I mentioned with the discount fee, if you would add that in. So, and the closing cost, this is a question I get fairly often is, okay, so that's really cool. Can I finance that? And on a purchase, no, you can't. Yeah. On a refinance, you can. You tuck all that in your refinance. But on a purchase, it's either coming right out of the buyer's pockets or you are negotiating with the seller to try and cover some or all of that. And you well know there are times where, heck no, the seller's not even going to think about it, right? If it's competitive, they don't have to do that. But more recently, we saw a lot more of that happening. Sellers, because there wasn't as much buyer activity, they were willing to negotiate through that. So in what I would call a more normal market, which we haven't seen in 3+ years, you'll see times where sellers, they're willing to negotiate through covering the closing costs, and sometimes they're just not. They're not interested in it. So you got to plan on. I tell most people, if you're in the $400,000 to $500,000 purchase price range, plan on $9,000 to $10,000 in closing costs. Kind of about that.
Okay, so around like 2.5% or so.
Yeah, probably a little over 2%. Is good rule of thumb.
Yeah. Okay, cool. Yeah. And then so with the recurring payments, then is the only thing that fluctuates is the tax? Well,
the insurance taxes will fluctuate very much by purchase price, but also by area. So as an example, just in this area, Fircrest, Tacoma, Gig Harbor are going to be pretty similar. Puyallup, pretty similar. University Place is always going to be more expensive. University Place just has higher taxes than these other areas. And that's simply because UP has their own schools, they do their own roads, they take care of it.
Right.
Most people notice when you drive through UP, the roads are all set.
Right.
And, so UP just charges a little bit higher in taxes. That's just kind of a normal thing. But otherwise, from across the cities, the taxes are pretty similar. But what can really vary is from home to home, because you might be looking at two homes that are for sale for $500,000, but if the assessed values are really different on those properties, and they can be, your property taxes can be quite a bit different. So that's probably the biggest variable when we look at recurring expenses, is what those taxes are.
Right. And that can fluctuate from year to year as well, right? Yeah.
Very much so.
Yeah.
Very much so. And then homeowners insurance doesn't change that much. It depends a little bit on who you're going through. In terms of the insurance company, you can always find a really cheap premium that may not be the greatest coverage in the world, right? So you really want to look at that. But insurance doesn't vary a ton. And then prepaid interest is based on the closing date. So let's take an example. Let's say we've got someone out shopping and they get into contract next week. So it's the first half of March, so they're going to close on April 15th. Okay, closing on April 15th, their first payment is going to be due on June 1st. Okay, so that June 1st payment covers all of May's interest. So then they would just have to cover the days left in April for closing. So roughly 15 days of prepaid interest. Okay, so if they're closing on the 23rd of April, now 7 days of prepaid interest. So that's what's going to determine how much that prepaid interest is.
So how much does a home buyer need to put down?
Yeah, and you know what's funny, Carl? I'm always surprised at the people who come to me and we start the conversation and say, well, we don't have 20% down yet. Like there's this idea out there that you have to have 20% down, and that's not even close to reality.
Yeah.
Conventional, we can go for a first-time home buyer as low as 3% down. 5% is pretty normal. 5 to 10% is pretty normal. Certainly if you're a move-up buyer, you've probably got a little equity, so that 10 plus percent. But on FHA, you're looking at 3.5% down, and VA, it's 0 down. So there's all kinds of ranges we can look at. And then we have down payment assistance that'll allow you with FHA or conventional to get to 0 down as well. So there's what I tell clients who are looking at both a low down payment or down payment assistance is, if you have the funds to go with the 3% down or the 3.5% down, go that way because it's a better loan for you overall. But if it's going to take you 6 months, 8 months, a year to save it, heck no, let's go. Let's get you in.
Right.
Let's do the down payment assistance. Let's get you in and building that equity. And then later on, we'll refinance you into one of the more regular programs.
Yeah.
So, but yeah, there are so many options out there for people.
So if you have, like, let's say 3% or 3.5%, deciding between an FHA or conventional, would you basically just go with the FHA if your credit score is maybe not as high?
Yeah, and that's another great question. So rule of thumb for me is if you're 680 or below, we're probably looking FHA, probably just automatically going FHA. Because at that point, the mortgage insurance on conventional is going to be quite expensive and the interest rate's going to be really high in conventional. When it's 680 to 700 is a little bit of a gray area for me. Then we kind of look at it and say, okay, if it's kind of a pick'em where the payments are really close, I would typically say go conventional. And the reason for that is eventually with conventional you can get rid of your mortgage insurance, but not with FHA. That's going to stay with the loan.
Right.
Okay. So the only way to get rid of it is to refinance into conventional down the road. So if it's really close, I usually say conventional, and then a 700 and above is almost always going to make more sense to go conventional. Now, I may have to change my tune on that a little bit because FHA just recently changed the rate that they charge for mortgage insurance.
Right.
And it's a pretty significant drop. It's 0.3%. I was actually just looking at this with a client recently where we had been debating over conventional and FHA. They were going to save almost $100 a month on FHA because of the lower mortgage insurance payment.
Oh, wow.
So that all of a sudden made FHA way more cost effective than conventional.
Right.
So it was pretty easy to make that choice. So we're still going to look at that, and we look at those side by side, and it's one of those things that's fun to do. I like to have these meetings either in person or over Zoom with clients where we're going through these numbers, and most of the time the client can look at it and say, oh, I want to go this way. It kind of reveals itself to them as we're going through the numbers.
Right.
So yeah, we gotta pay attention to that. There's been a bit of a stigma associated with FHA because of the mortgage insurance. The fact that it's getting cheaper is going to be a real positive. The fact that it stays the whole time is kind of the little bit of the drawback. But otherwise, FHA is a terrific program.
Yeah.
Just a great way to go.
Yeah.
So, and the whole mortgage insurance thing, part of the thing I think with the 20% down is that there are financial advisors out there who's like, no, put 20% down. You got to put 20% down. I'm personally not a big fan of that because I think you're missing out on the idea of building equity all that time.
Yeah, right.
And there's lots of ways to handle mortgage insurance to make it more affordable. So to the point, I've had a number of people come to me saying, I'm putting 20% down, George. And I know from looking at the numbers, 20% down, they can handle it, but it's going to tap their resources down so low. And I'll usually say, do you want to just take a look at 10% down and see what that means? No. Get a little further in. Do you want to look at 10% down? And honestly, Carl, a lot of times we look at 10% down and they'll go, oh.
Yeah.
Oh, that's okay. Yeah, it's okay. And then you've got this money for reserves or to do a little work on the house or whatever it might be.
Right.
I am much more comfortable having someone put 10% down and have a little bit of mortgage insurance than tapping themselves out completely and now they're down to $1,000 in their savings and let's have a little more money than that.
Yeah, and what happens if like a pipe bursts
Exactly.
or something like that? Yeah, absolutely.